is Ben, co-founder of the TopHouse Real Estate app, where you can find homes for sale, for rent, and even sold listings. You can discover homes with short video walkthroughs by some of the top real estate brokers and agents in your local neighborhood. Today, I'm joined by Michael Neal, one of Canada's top mortgage brokers. He's been in the industry for 18 years. He is the co-founder and partner at North Power Mortgages. I'm really excited to get his take on what's happening on the front lines in the mortgage industry and how that's impacting the real estate market. Without further ado, let's get started. Michael, thanks for joining us.
Thanks for having me.
What is happening in the market right now?
I mean, on the financing side, there's definitely some turmoil. We've seen a lot of shifts. Rates have increased drastically over the last 3 to 6 months. Certainly not something that we saw coming. If we had a crystal ball, things would be a lot different for all of our clients, myself included.
Why do you think there was such a surprise in that shift?
Truth be told, I think it has a lot to do with what's happening in Europe. I think that played a huge impact and definitely accelerated some of the increases along with inflation, which, rates moving up, they were trying to combat inflation. Inflation was starting to run away with what was happening over in Europe. So all of a sudden, here we go on a drastic upswing.
Right. And so where were rates at 6 months ago versus what they're at today?
Rates are probably on average. Well, we know that the overnight lending rate is up 2.25%, bare minimum. Prime was at 2.45%, and now we are at 4.7%. Now, that's obviously not the Bank of Canada prime. That's the bank prime, so a little bit different. Fixed rates were on average, let's say, 2.5%, and now they're north of 5% on average. I'd say about 80% of the business that we saw went into variable rates.
And so if you have a client today, would you recommend that they go variable or fixed?
So making a blank assumption is really tough. We always try and place the client in the right product. I think that fixed rates today don't relate or correlate to where the market is. We're actually seeing the bond yields come down. We haven't seen fixed rates lower yet.
So you're seeing Government of Canada bond yields come down, and typically the 5-year fix will come down with that.
It should, but that's not something we're seeing over the last 2 weeks.
Right. So where do you think the market is headed in terms of price and volume?
I think we've had this conversation before. Location. I think that in the Greater Toronto area, we are going to see prices stay, give or take, where they are. I think in the outlying areas, the further north you go, you are going to see some correction. But over the last 2 years or 3 years, they saw increases of 50, 60, 70%, depending on location. The longer you hold the asset, it's going to fluctuate, but it will continue to grow.
So are you seeing a lot of difficulty in getting mortgages now by the clients that are coming through now, whether that's refi or purchases?
Everything has become more challenging, from clients having multiple properties. But let's just go into the basics. You're a first-time buyer. Over the last 4 months, your buying capacity, just because of qualifying changes and rates, is probably down anywhere between 10 and 15%. So if you were a first-time buyer 6 months ago, you could afford a $999,000 home. Now you're probably in at around $825,000, $850,000, depending on circumstances. Like, we had rates that were at all-time historic lows. Right. They're trying to build a safeguard into the market. It totally makes sense. Where we are today and with where rates are, we don't believe that rates will go north of 7%. We're not going back into the early 90s, late 80s. So prior to 2016, most institutions used to do it based on the 3-year fixed term posted rate, unlike the mortgage qualifying rate that we have today, which seems a little bit more unrealistic at 7.25% today.
Right. Because of the government implementing this qualifying rate, do you think there's going to be much less delinquencies in the market?
Delinquencies have, in the last, let's say, 15 years, delinquencies have been at an all-time low. I think we'll continue to see really low delinquency numbers. I think that we saw it. If if you look at COVID, there were a lot of special arrangements that took place. No bank wants to own real estate. They just want to collect payments, get their interest, be done with it. So there'll always be arrangements. I think delinquencies will stay, sub 2-3%. I don't even think they're at 2% currently. We haven't seen any job losses as of yet, like mass layoffs, in generalized sectors, so to speak.
Real estate has been such a great way to build wealth for those that want to continue to build rental properties and again secure their retirement. What do you recommend for them? Is this the right time to get into the market?
I think that when the right investment comes up, it's the right time.
And what does right investment mean? Is it cash flow?
I think it's a multitude of things, but cash flow is king. Cash flow is how you're going to afford the mortgage payments. Right. So cash flow is primarily what we look at in terms of right investment.
My understanding is today, most of the properties that you would buy, as if they're, let's say, single dwelling, do not cash flow at the price points.
Well, it depends on the size of the loan, but on average, I would agree with you. No, they don't. But getting you closer to the black is a lot better than being deeply, deeply in the red.
In the red, right? And has it always been the case that a single dwelling unit doesn't cash flow, or is that sort of a recent phenomenon because maybe the market's pricing in much higher, appreciations in the price?
So historically speaking, at maximum loan to value on a rental property, no, they haven't really carried. Now, that being said, over the last 3 years, because interest rates were so low, we were starting to see basically, nobody was out any money on a month-to-month basis. So fast forward to today, when interest rates have gone up, let's say 200%, and we reflect back on affordability and qualifying, no. Rental, even though rents have gone up by 20 to 25%, depending on the unit, single family, multi-family, on average, they're still not going to carry. So as an investor, do you want to be looking at it like forced savings? And this is a lot of the conversation that we have with our clients that, some clients invest on a regular monthly investment plan with their investment advisors. They put in $1,000 or $2,000 or $500, whatever the case may be. Right. We look at rental shortfalls the same way. Do you want to invest in that property on a month-to-month basis to cover off some of the property taxes or the maintenance fees, whatever the case may be, because over the long term, that money is going to work harder for you. To save up $500,000 is a lot more difficult than buying a $500,000 asset and paying it off over 25 years.
That's right. Yeah, and again, for me, especially, when I was living downtown, bought my first place, you're going out a lot. If you don't have that automatic savings, that's paying down the mortgage, then sometimes you just have an extra night out, and all of a sudden that money is gone. So for sure, it's an awesome way to have forced savings. I've also seen some clients that, again, trying to build a rental portfolio struggle with banks when they get to, say, 3, 4, 5 units. Talk to me about why that's an issue, and how can people build a bigger portfolio?
So we're certainly seeing it that every bank has their own qualifying, and we know that. Some it's 3, some it's 4. They all have their own qualifying criteria and their own way to qualify rentals. Once you get to 3 properties, depending on lender, they look at a cash flow spreadsheet. So what's coming in versus what's going out. There's vacancy, there's repairs that's added in. If we can get to a point where you have $1.1 coming in for every dollar going out, you're not going to see a lot of trouble qualifying. What ends up happening based on where rents were and what mortgage payments were, and we touched on it briefly, you're going to see a shortfall. So when we see a shortfall, most institutions don't love that idea. because they are looking at it like a true investor. If you're negative, where's the negative going to come from? It's got to come from your pocket. But if you already have personal liabilities as well, is there enough capacity within your income? So there's always going to be a struggle when we're looking for maximum loan to value, because large in part, it's not going to cash flow. The bank isn't the only place to go. And every lender has their own qualifying criteria. And some are going to be a lot more stringent, i.e. big five banks, and others are going to be a little bit more lax. They might look at it like, I'll use 100% of the rental income to qualify versus 50% depending on the lender. So there's always a way to look at it, and there's never a shortage of money. It's just, where is the money going to come from, and at what cost is this money? I think we do need to take, as an investor, you need to take the emotion out of it. There's no emotion in it. It's, does this investment make sense with this math?
Right. In 2008, during the financial crisis, the market froze maybe for a 6-month period.
Yeah.
Prices did come down, but it was a very quick rebound. 2017, pretty similar, and 2020 in the beginning of COVID as well. Very quick rebound. What about today? Are we going to see a quick rebound in this sort of market slowdown, or is it prolonged because maybe rates are higher and harder to get a mortgage?
I think the government had a lot to do with getting the markets moving again in 2008. Once the liquidity issues were over and banks were lending to banks again, that fixed a lot of the problems. Fast forward to COVID, all of a sudden monetary rate policy, banks are lending to banks again, off we go to where we are today. I don't think we're going to see any change from the government to help speed the market back up. That's exactly the opposite of what they want to do. I think that the market will do it on its own, but at a much slower and steady pace. I believe that where we are today, we will continue to see growth in certain areas.
In today's market, rates are changing so quickly. Maybe appraisals are coming in at different price points, different than what you would expect. What advice would you give your agent referral base?
What I would say to all of our referral partners is, get the deal done today. Don't wait. The market will shift, and we saw it shift, and we saw values change slightly. For all of our clients, the deal was done. We get obviously the agreement of purchase and sale. We get it to the lender immediately, and we do our best to find out if we need an appraisal immediately. Those are the key touch points. If we have a done deal and it's done within 3 or 4 days of when that agreement of purchase and sale was signed, we have not seen any issues with value. Mm-hmm. There's no concern. Those clients, you as an agent know you're closing, they got the money that they needed, everything is done. If the client waits a month or 2 months, and we saw this in April, and you don't get an appraisal until June for a July closing, there was certainly some issues. I wouldn't say that they were hundreds on hundreds, but it's not a great conversation, and it's not because the agent didn't do their job. It's based on timing.
And so, if the appraisal comes in short, what happens?
Depends. Every situation is different. Some people, it can just be absorbed in the loan, depending on what the original loan to value was. Sometimes we need to look for alternatives, and sometimes there is no alternative.
And so when there is no alternative, the deal falls apart.
Unfortunately, yes.
And are you seeing a lot of that happening today?
We aren't. The majority of times when we've been in that situation, we've been able to find some sort of resolution. It's a case by case. Perhaps there's other assets, perhaps there's other resources. It's always case by case, but we haven't seen many deals fall apart for those reasons. The thing we are seeing the most of is when a client is buying before they sell. And we've certainly seen circumstances where units haven't sold. And that can always be a pain point or an issue.
Right.
Less about the deal appraisals, more about sale of existing properties.
And there's a domino effect there where now you can't close on the property you
Correct.
purchased because you haven't sold, and then that person that sold can't close on theirs because now you can't close. Is that been a huge issue recently?
It hasn't been a huge issue. Again, case by case. We've been very fortunate that we've been able to find workarounds or solutions for the clients. A lot of our clients ended up keeping the existing properties. In some cases and points, though, it's not ideal for the client. Prior to COVID, everybody, and during COVID, everybody was buying before they were selling.
Right.
It was, well, I don't want to be left homeless. Now the advice from us is, at the very least, be ready to list. Don't wait, or even better, list ahead of time.
Sell first.
Sell first,
Then
buy after.
Right.
There's a couple reasons for that. If you need all of the money in which is in your home currently for your next property purchase, get the finite numbers that you need by selling first. You're not in a place where you have to buy before you sell.
So you know exactly what you can qualify for once you've sold. You know your price, how much money is coming in your hand. Now you can go comfortably look, and there's
one less stress for sure.
There's now enough inventory on the market versus 6 months ago. It was a drastically different environment. You were really worried about
being homeless. Nobody wants to be homeless. Homeless with a big fat bank account, but homeless nonetheless.
For new realtors that are coming into the market and they want to be more successful and do more deals, financing is such an important part of getting deals done. What kind of advice would you give new realtors, and sort of broadly, what kind of mistakes do you see them making?
Things that can be done, quick checklist. What do you do for a living? Are you self-employed? Are you employed? Basic stuff. Where's the down payment coming from? Is it coming from mom and dad? Is it from your own savings? Are you accumulating it? Where are you? A couple of basic questions should be able to give the agent an idea of, is this a 6 to 9 month transaction? Is it a 30-day transaction? How serious are they? If they say that they're waiting on their down payment to come from a different location, or mom and dad are going to be giving them a sizable gift, that will give you a big indicator. But knowing just the basics questions, like, what do you do for a living? Where's your down payment? So on and so forth, was going to give the agent a lot better idea of timing. Understanding that financing is the second largest part of the transaction. Finding the property is obviously the biggest part, and then getting money to buy the property is the second biggest part. And you need to know how serious the buyers are. Right. Are the buyers working with somebody? Are they pre-qualified? Did they do a pre-approval? Do they understand what the difference of those mean?
So tell me about how the distribution of mortgages you're doing have changed pre-COVID, during the sort of the hot time of the COVID environment, and now today. Was there a lot of investors, end users, and then speculators? Talk to me about what you're seeing.
Large bulk of our clients primarily were end users. Now, that doesn't mean that we didn't do a transaction where clients were taking equity out of one property to buy that end user property.
If you had to put a percentage on it, what percentage of your business is investors? And by investor, I mean, let's say somebody that's buying a unit to rent, not their primary home, versus they're buying their primary home.
I would probably say today 65-35 is probably our mix to that. 65% end user. 35% investor, rental property.
Pre-COVID, what would you say that was at?
Pre-COVID was actually probably higher. We did a lot more rental.
More investors.
More investors.
Okay, so why do you think that changed?
That changed for us primarily because of our clientele. Our clientele were more rental investors, multiple 10, 15, 20 unit investors, and that got scaled back for a multitude of reasons.
Was it because of the banks and the lenders that made it more difficult?
Definitely played a huge part. That's for sure. Banks, typically speaking, cap out around 5 to 10 units, dependent. Now, sometimes that's 5 to 10 units with one individual bank. Sometimes that's 5 to 10 units in total.
Right. We've seen volume come down as much as 40, 50% in terms of transactions happening. Is that primarily because mortgage rates have gone up, or is it a lot because people are just afraid right now and they think the market's going to go down, so they don't want to pull the trigger and they're waiting?
I think it's a combination of a few things. If we look at where we were as a group in 2019, we are well ahead of 2019. We are ahead of 2020. 2021 in our business was one that I think every mortgage broker, every real estate agent will remember as the good old days, the good times.
But at the time you're in it, you also know that it can't possibly last.
I mean, we hoped it would, but unrealistic nonetheless. When we look at it today, as a company, we are probably down 25% from where we are in 2021. Mm-hmm. That's still an amazing number when we look at it that way. I think that we are seeing, it become more of a balanced market. So there's going to be less transactions. And everybody has to capitalize on the transactions that are available.
What I really want to know is the market just afraid, but there is capacity for qualifying? Or is the market just not able to qualify? Buyers have been pulled out of the market because they can't qualify with these higher rates.
On a whole, I would say that we've lost some buyers for sure. We have some concerned buyers that will absolutely qualify. Mm-hmm. I think that on a whole, it's a little column A of what you said. It's a little column B. I think everybody is waiting for things to settle in. A large factor that isn't discussed there, truthfully, is where we are in the calendar year. Summertime is always traditionally slow.
Right.
So I think we will see some uptick come September, October.
We've come down from the peak of February. Maybe average price points were around 1.5 million. Now we're probably looking at just over 1 million. And that's quite a substantial decline in average price points. Do you think we have settled now and it's going to be up from here, or we'll have a maybe uptick in September, October, but then again, it's going to be a long road ahead?
I'm all for slow and steady growth. I would love to see 5 to 7% realistic growth. I believe that we will see the market stay at where we currently are. I don't anticipate any other massive drops in the market. That being said, we never know what's going to happen overseas, which is playing a huge part in everything. We can't discount that. So without discounting that, I do believe we are going to see more transactions in September, October, November. Then we're going to see a slow again December, January, and things should pick up again February. That's normal.
That's the normal.
That's the way it's been.
The last 2 years, I mean, seeing crazy numbers in January, that was not really normal.
No, that is not normal. At least in my experience in the business.
Well, with that said, I want to thank you for doing this, and I'm sure we'll do it again soon and get another market update. Michael Neal from Northbound Mortgages.
Thank you so
much.